Week for spin-off, certainly. Yum brand spinning out of China. It's China business, making it a separate publicly traded company away from the parent of Yum. Ferrari, a spin-off of Fiat Chrysler, going public on Wednesday. Our next guest says this is only the beginning of a string of many more spin-offs and diversifications there. The big banks, he says, may be next. Joining us right now is Edge Consulting Head of Research, Jonathan Morgan. Jonathan, good to have you on the program.
Great, thanks
so much for joining us. So what's behind all of these spin-offs?
So we're seeing a lot of spin-offs being pushed to break up because of the way that the market is at the moment. So in this case, China, there's a bit of a downturn there. So how are Yum brands going to compete with the rest of its competitors like McDonald's and Starbucks? And they see a breakup as an opportunity. So removing the lower margin business from the higher margin business going forward. And that's where you're going to see creating shareholder value, because the management team will be separate. They'll be able to focus more on the Yum brands China itself. And then, of course, you have the parent company, which will be picking up the royalties going forward.
But is this because of activists pushing companies to do something in this low-growth world where you are worried about China?
I think so, yes. You know, we've seen a little bit of an uptick in IPOs this year, but not as much in the past. And that has to do with regards to not listing on the market. In fact, with Ferrari, which IPO'd recently this week.
Big deal. It did well, too.
They're also going to be doing a spin-off, so that's only 10% listed on the market. We have another 80% coming through in Q1 of this year. So there's a lot more value in doing a spin-off, especially because it's tax-free. You're not going to be being taxed on the sell or the distribution going forward.
Do spin-offs typically work, Jack?
Well,
do you want to invest in a spin-off?
There's a good argument for them, which is that rather than having this dispersed company, this conglomerate, you've got management focused on one aim. They're motivated because now, again, they're not reporting to the man. You know, they've got their own company. They know what they're doing, and they'll improve. What worries me sometimes is that you see this cycle where CEOs want to be empire builders. So when interest rates are low, they lever up, they buy companies, they mush them together. 5 years later, what do you know? It doesn't work out. They spin off. And, of course, investment bankers make a lot of fees and money both ways. So they're saying, yeah, this is a great idea. You know, let's merge, let's spin off. And in the end, you know, there's a lot of friction, and the shareholder is the one who ultimately give up the bucks for that friction.
And you know what's interesting about that is I'm not here to promote spin-offs, because actually our study, we did a 15-year study with Deloitte, so looking at 15 years of 4,000 deals. It actually shows 4 out of 10 spin-offs don't work in the first year.
4 out of 10 in the first year.
So therefore, that's where we come involved, and we tell clients to really look at the parent company and the spin-off separately to see where the value is, rather than just buying the parent company, getting the distribution, and then seeing what happens from there.
All right, we will leave it there. Good to talk with you, Jonathan. Thanks so much.
Fantastic.
We appreciate your time today. Jonathan Morgan is Edge Consulting Head of Research, joining us on spin-offs. Of course.